Welcome to HYSA Power Play. Today we will show why your emergency fund may be underperforming and how a high-yield savings account can fix that by keeping your cash liquid, federally insured, and earning more than traditional savings. We will also compare HYSAs to CDs, Treasuries, and money market funds and share practical steps to set up an account. Finally, we will include a few quick quizzes to help you lock in the key ideas. To begin, let's review the plan for this video. Here is our agenda. We will start with the importance of an emergency fund, then examine why HYSAs are often the superior vehicle. We will walk through the $10,000 debate to show why instant access beats chasing marginal yields. We will cover core rules for savers, a step-by-step setup guide, practical rate hunting tips, and a couple of quick quizzes. Next, let's explore why HYSAs stand out for emergency preparedness. When an emergency strikes, you do not want to wait or pay penalties to access your cash. A high-yield savings account provides a balance of safety, liquidity, and better than traditional savings rates. Unlike investment accounts that can fluctuate or fixed-term products that lock you in, HYSAs typically allow immediate or near-immediate access with no early withdrawal penalties. In short, your emergency money stays ready and still works for you. Now let's frame the $10,000 debate and why safety and access come first. If you have around $10,000 saved and no debt, you are ahead of the curve. The most important job of that money is to be immediately available when needed. Trying to squeeze out a slightly higher return at the cost of access can backfire. A practical approach is to keep a smaller portion in checking for day-to-day bills and the majority in a high-yield savings account, where it earns more while staying accessible. In other words, liquidity comes before yield for emergency funds. Next, let's compare HYSAs to common alternatives that may lock your cash. HYSAs typically beat traditional savings on yield while keeping access simple. Certificates of deposit often pay well, but impose penalties if you need the money early, which undermines an emergency fund's purpose. Treasury securities can be sold before maturity, but may involve price risk and settlement delays. Money market funds are convenient for many goals, but may not be bank deposit insured and can involve settlement timing. For the pure emergency use case, simple and penalty-free access in a high-yield savings account tends to be superior. Now, let's crystallize the differences in a quick comparison table. This table summarizes typical trade-offs. HYSAs offer high liquidity with no early withdrawal penalties and are generally federally insured when held at banks or NCUA-insured credit unions. Traditional savings accounts are similarly liquid but often yield less. CDs lock funds and penalize early withdrawals, making them unsuitable for emergencies. Treasury bills are very safe from a credit perspective, but can face price fluctuations and settlement timing if sold early. Money market funds are convenient but may not be deposit insured and can involve settlement delays. Next, let's visualize your overall emergency fund strategy with a mind map. This mind map centers on your emergency fund. The liquidity branch highlights instant access, linkage to your checking account, and knowing your transfer speeds. The safety branch emphasizes using FDIC or NCUA insured institutions and respecting coverage limits of $250,000 per depositor per institution. The growth branch reminds us that HYSA yields can be competitive for cash without sacrificing accessibility. The setup steps branch walks through opening an account, confirming insurance, linking checking, automating transfers, and building 3 to 6 months of expenses. The pitfalls branch warns against CDs with penalties, settlement delays in some instruments, and chasing small yield improvements at the cost of access. The use cases branch clarifies that this cash is for emergencies and near-term goals, not long-term investing. Now let's translate these principles into concrete rules. Adopt these core rules. First, prioritize liquidity above all else in an emergency fund. Second, verify FDIC or NCUA insurance and understand the coverage limit of $250,000 per depositor per institution. Third, build your financial foundation early, including responsible use of a starter credit card to strengthen your credit profile. Fourth, keep the emergency fund setup simple and avoid complex vehicles for this purpose. Separate your goals so long-term investments do not cannibalize your emergency reserves. Sixth, maintain a quarterly review routine to confirm your APY remains competitive, your transfer speeds are acceptable, and no new fees have crept in. Up next, let's walk through a step-by-step setup. Follow these steps to set up your HYSA efficiently. First, select a reputable institution offering a competitive high-yield savings rate with minimal fees. Second, confirm that deposits are federally insured through FDIC for banks or NCUA for credit unions and that you understand the coverage limit. Third, open the HYSA and link it to your primary checking account to enable smooth transfers. Fourth, automate contributions from each paycheck to build 3 to 6 months of living expenses. Fifth, maintain a small buffer in checking while keeping the bulk of your emergency fund in the HYSA. Sixth, review your account quarterly for APY competitiveness, any new fees, and to validate transfer speeds remain acceptable. Next, let's visualize how money flows between accounts. This sequence illustrates the ideal cash flow. Your paycheck lands in checking. An automated transfer moves a fixed amount into the HYSA to steadily build your emergency reserve. Your bills are paid from checking as usual. If an emergency occurs, you initiate a withdrawal from the HYSA and transfer funds back to checking for quick disbursement. If no emergency occurs, the HYSA continues to accrue interest. Automation and clear rules reduce friction and decision fatigue. Next, let's test your understanding with a quick quiz. Question: which account type best balances safety and instant access for an emergency fund? Options are high-yield savings account, a 12-month certificate of deposit, a 10-year treasury bond, or a cryptocurrency stablecoin on an exchange. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the high-yield savings account. It provides a strong combination of liquidity, federal insurance when held at an FDIC or NCUA insured institution, and a competitive yield relative to traditional savings accounts. CDs, Treasuries, and crypto either introduce penalties, price risk, or platform risks that undermine the emergency fund's purpose. Next, another quick question on insurance coverage. Question: what is the standard federal deposit insurance limit per depositor, per institution? Options are $250,000, $100,000, $500,000, or unlimited. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $250,000 per depositor, per insured institution, per ownership category. Confirm your institution's insurance, FDIC for banks or NCUA for credit unions, and structure accounts accordingly if you have larger balances. Next, let's look at smart rate hunting and maintenance tips without sacrificing access. Hunt for better yields the smart way. Evaluate the net outcome after considering any fees, transfer speeds, and usability. Maintain instant access as the top priority, including knowing transfer limits and any withdrawal restrictions. Automate deposits to stay consistent. Revisit rates each quarter and consider moving only if the improvement is meaningful and does not compromise speed or simplicity. Always confirm federal insurance, fee schedules, transfer times, and the reliability of the mobile and web experience. Next, a brief but important disclaimer before we wrap up. This content is for educational purposes only and is not individualized financial advice. Always verify current APYs, fees, transfer limits, and terms directly with your bank or credit union. Confirm insurance coverage details and ensure they apply to your specific ownership category. Your needs, risk tolerance, and time horizon may differ from the general guidance presented here. Consider consulting a licensed professional for tailored advice. Now, let's consolidate the key takeaways. These are the most important points. Liquidity outweighs yield for emergency funds. Use federally insured institutions whenever possible. High-yield savings accounts offer a strong balance of access and return for emergencies. Automate deposits and maintain a tight link to your checking account. Review rates, fees, and transfer speeds every quarter to keep your safety net optimized. Finally, let's summarize and outline your next steps. In summary, stop settling for low-yield accounts that do not serve your emergency needs. Shift your safety net to a high-yield savings account where it remains accessible, federally insured, and productive. Automate contributions, keep a small buffer in checking, and avoid locking up emergency cash in instruments with penalties or settlement delays. The most important step is to start today, so your emergency fund is ready when life happens. Before we sign off, here is a quick call to action. Thank you for watching. If you found this valuable, please like, share, and subscribe to support the channel. Tell us in the comments how you are structuring your emergency fund and which HYSA features matter most to you. Your tips may help someone else get financially prepared. See you in the next video.